So basic preparation must be seen. So if I have to go to the Nestle Financial, we were using as our case study. So this is the Nestle Financial. So look at what they wrote. They wrote basis of accounting. Look at it. Basis of accounting. Basis of accounting. Now, the first thing they did was the statement of compliance, saying that these financial statements have been prepared in accordance with international financial reporting standards. Of course, in Nigeria, they went ahead to include the provisions of the Company and Allied Matters Act 2020 and in compliance with the Financial Reporting Council of Nigeria Amended Act 2023. They were authorized for issue by the Company Board of Directors on 23rd February 2024, for example. Now, this is fine. Now, but please, the heading is not, it should not be basis of accounting. It should be basis of preparation. IFRS is beyond accounting. It's not just about accounting, it's the reporting standard, right? It's about reporting. So it's not beyond accounting. That was why the name accounting standard was substituted with reporting standard. So the heading should be basis of reporting. You can see that sort of undertaking of compliance, of unconditional compliance with the preparation of this set of financial under the IFRS framework that we can see. They went ahead to state the measurement basis, how they measured asset and liabilities, for example. And also they went ahead to state the functional or presentation currency. Now take note, what is mandatory under the base of preparation is that the financial have been presented or have been prepared in line with IFRS accounting standards. That is number one. In Nigerian case, of course, also in line with Company and Allied Matters Act 2020, and then the IFRS Act 2023 as amended. That is what is primary. Then followed by the base of measurement. How did you measure the assets? How did you measure the liability? Which assets were measured at historical cost? Which one were measured at fair value? Which other items were measured at net realizable value, as the case may be? Those are measurement bases. Liabilities. Which ones are measured at amortized cost, for example? Which ones are measured at fair value? Which obligations are measured at present value, as the case may be? And which ones are measured at fair value? So these are the items. These are how you describe how elements of asset and liabilities are measured. The flow from asset and liabilities are the income and expenses we recognize in the statement of profit or loss and other comprehensive income. So the flow from these assets and liabilities goes into statement of profit or loss and other comprehensive income. That is that about that. So my point is, under base of preparation, what is mandatory is that you state that the financial statement have been prepared under or in accordance with IFRS accounting standards, CAMA, and the FRC Act as amended, and also the measurement basis. Now, information concerning the date of approval, who approved the financial, the presentation currency, the functional currency, the rounding of the amount, whether to the nearest thousand, million, billion, or trillion, this five set of information may be presented within where you present about the reporting entity or within under base of preparation. It's either here or there. So Nestle has gone with this option, it is fine. You can as well present them under where you have a reporting and the information about reporting entity. That is all to take note. We continue with our checklist. We move on quickly. Apart from base of preparation, next, the going concern status of the company. The going concern status of the company. In a set of IFRS financial statement, an entity must state the status of the going concern. Is that entity, is that company, is that organization or institution still a going concern? Is it so? It's very important. Is that institution, organization, and is it still a going concern? So that must be stated. And IFRS contains the issues or items that are to be evaluated before concluding that an entity is a going concern. Right? So are there situation warranting that are there legal compliance issue that our entity will be unable to meet with altruism continuity as a legally incorporated or licensed entity to continue to be in operation? Are there conditions that create the unavoidability that an entity should discontinue operation? What are the issues? So IS1 gives us that idea under the going concern heading in that standard. So a set of IFRS financial statements must state categorically whether an entity is a going concern or not. So this is a mandatory requirement that must be seen. If we go to our case financial we're using, if we scroll down, let's check. Okay, probably it's going to contain somewhere down the line. Let's move on. But let's take note that the going concern status must be reflected in the financial. Apart from the going concern status, information number 8, new IFRS is issued and amendments applicable at the year end for the first time. In a reporting year, it is possible that a new standard has been issued. When a new standard has been issued and an entity is applying it for the first time, the standard requires that some disclosures should be made whenever an entity is applying a standard or a new set of standards for the first time. Let's take a typical example. When an entity was preparing its 2019 financial statements, if that entity was involved in leases, that would mean that in 2019 accounting year end, that entity will have applied IFRS 16, which is on leases. 2019 January 1 was the beginning of the mandatory applicability period when an entity was required to apply IFRS 16. Therefore, in the 2019 financial statement, an entity must have a section where it describes or outlines the set of standards that have been applied for the first time in that reporting year end. So that is what this requirement is requesting for any entity that is applying a standard or an amendment for the first time. We are not sorry, I think there was an interruption there, a network interruption, but we proceed from where we were. So we are not talking about, you see, when a standard is applied for the first time, right, by an entity, we are not talking about an entity that is crossing over or transiting to IFRS. We are saying you are already in the IFRS environment, or you are already within an IFRS framework. But when you are applying a standard for the first time, you are required to list the name of the standard. There may not be new standard, there may be amendments to existing standards. Therefore, when an entity is applying a standard for the first time, or is applying an amendment to existing standard for the first time, that entity is required to do a listing of those standards or those amendments to existing standards that are being applied for the first time. What information is required concerning these standards that are applied for the first time? We can find it in IS 8, paragraph 28. Paragraph 28 of IS 8 lists out the information to be disclosed concerning new standards or amendments to existing standards that are applied for the first time in a current reporting year end. Information like, information concerning the asset or liability or income or expense line item affected. That should be stated in the disclosure. A computation, for example, of the impact on earnings per share where applicable, and every other line items, all other line items rather, that are affected by the date of application of that new standard or the new amendment to existing standards. So there must be a section in the report stating the list or collection of the new standard that have been applied for first time, an amendment to existing standard. That is very critical. That is very key. Very, very key. Let's take note. Now we go ahead on the information required to be contained or disclosed in the financial statement. There's a number 9. Number 9 is like number 8, but there's a difference. In number 8, we refer to standards that have been issued or amendments that have been issued for the first time that are being applied by that entity in its current year. But there's some standards that have been issued which are not yet mandatorily applicable. They are not yet, mandatorily required to be applied by an entity. In other words, the date for their mandatory application is in the future. For example, the date for their mandatory application is in the future. So those future standards have one or two things that must be said about them in a set of IFRS financial statements. Therefore, number 9 is saying, for those new standards that are not yet effective, that is the word of the standard, that are not yet effective, meaning they are not yet mandatorily required to be applied, those standards or amendments to existing standards that are not yet effective, for example, and then is required to do a listing of those standards, describing the requirement or the summary of those standards, and then ultimately how the application of those standards will affect the financial status of that entity. 3 things, basically, principally. The listing of those standards and amendments, a summary explanation of those standards and their amendments, and the financial implication in the financial statement of that entity if those future standards were to be applied. If those standards were to be applied as at the reporting date, what will be the impact on the financial status of that entity? These are requirements expected of by a preparer or reporting entity with respect to standards that have been issued which are not yet mandatorily applicable. That's what we are saying. Let's take 2024 as an example. If we're preparing a financial statement for 2024, what are those standards we can list as new standard not yet effective? In other words, as new standard not yet mandatorily applicable. What are those standards? Now, let me ask, please, can anyone tell us, please, new standards that have been issued which are not yet effective for the year 2024? You may unmute and speak. Or you may use the chat box if you want to. Can anyone give an example of a standard or standards that have been issued which are not yet mandatorily applicable or that are applicable in the future? Can anyone do that? Yes, a chat has come in and the chat say IFRS 18. Thank you, Ekunuga Michael, IFRS 18. And Ekunuga Michael, what is the name of IFRS 18? And somebody else can still tell us what other new standards have been issued that are not yet mandatorily applicable. You may unmute and speak. You may unmute and speak, please, if you want to. Or you may chat in your position if you feel that way. Yes, Michael, thank you. Presentation and disclosure is that an error? Not off. It is presentation and disclosure in financial statements. Presentation and disclosure in financial statements, not of financial statements. Thank you, Michael. Then also IFRS 19, Michael, yes. Michael, on IFRS 19 is applicable immediately. Is applicable immediately. So to come under those information for item number 8, which I mentioned before, IFRS 19 was issued this year, rather has been issued this year, but is applicable immediately, not even a time in the future. So to come under those category of number 8, not number 9. So in number 9, we have IFRS 18, like Michael mentioned, which is IFRS 18, which is presentation and disclosure in financial statement. That's number one. Number two, we have an IS 8, the one I told you as the retired IS 8, based on preparation of financial statements. So that is not applicable in the future from January 1, 2027. And there's an amendment to IFRS 9 and IFRS 7 titled Classification of Financial Liabilities. Classification of financial instruments. So there's an amendment. It was just issued. It becomes applicable in year 2026, for example. Now, these are just examples of some of those things that you need to list out, give a summary of their meaning, and then state the financial impact if they were to be applied. Also, the standard allows us, if a reporter or a preparer feels that we are yet to ascertain the quantitative impacts, the financial impacts, or the financial statement impact, you can also state that the impact of the financial statement has not been evaluated or has not been determined. You are allowed to do that. You are not forced to state the impact. So we move on to item number 10, key sources of estimation uncertainty. Yes, Oluwafemi, someone is asking, please, we kindly need the recorded version of the meeting. Thank you. Now, all the recorded version of this will be uploaded on our YouTube channel. All of them, nothing is being hidden. Everything will be uploaded. So just go there and play them as much as you want, and also share with your colleagues. Everything will be uploaded. Nothing is being kept behind at all, because the purpose is to give a hand-holding experience for those in our final year that will be going to the work market. I don't like calling it labor market, right? You'll be going to work. For those awaiting NYC, for those on NYC, and for those who have just completed the NYC, these four sets of graduates or graduating persons are our focus in what we do. So the next item is key sources of estimation uncertainty. Now let me make it known to everyone here. When we report in financial reporting or in accounting, we are not saying it absolutely that the current amount of deferred tax of 10 million is actually 10 million. We are not saying absolutely that the motor vehicle, that the current amount is 2.3 million, is 2.3 million if we are to realize it. We are not saying it absolutely. We arrived at this amount following certain estimation, certain assumption that we have made. Because some information, some variables considered in measuring assets and liabilities are uncertain. For instance, depreciation. How sure are we? Are we absolutely sure that motor vehicle will only last for 4 years? No. But the policy thing we need to do, we say 4-year lifespan. So under the straight line method, the cost divided by 4 years, if we assume there won't be a residual amount, residual value, the cost over the number of years will give us the annual depreciation. If we estimate there's going to be a residual value, the cost minus the residual value will give us the depreciable amount, which will now depreciate when we divide by the useful life. Look at this. The lifespan is an estimation. Residual value is an estimation. Therefore, IFRS accounting standards recognize that estimations are often done. And these estimations affect the kind amount of assets and liabilities. Therefore, in your financial statements, or in the financial statement of an entity or an enterprise or an institution, oh my, the network is really bad, but we just have to move on. So as I was saying, now when we talk about those assets and liabilities, those estimations you make, which you apply in doing the evaluation, those estimations needs to be reflected, communicated to the reader of a financial statement. or a set of financial statements. That will mean key sources of estimation uncertainty. Please, this applies only to assets and liabilities. Information about key sources of estimation uncertainty applies only to what? Assets and liabilities. Only assets and liabilities. For example, if you write a PPE, for example, tell us motor vehicle, what you estimate to be the lifespan of the motor vehicle, or what you estimate to be the lifespan of a plant, of a machinery, of a factory, and you say you estimate it to be so number of years. However, based on latest developments, there might be a need in the future to change or adjust the useful life or economic lifespan of that item of PPE. And either the revision of that item of asset or liability, that the current amount of that item will change. That's how we will write it. That's how we word it. Deferred tax asset or liability is another example. In deferred tax asset or liability, you are mirroring the future impact of income tax based on the entity's current transaction as at a period end. What happens if that entity is a medium-sized company under the Finance Act? A medium-sized company under the Finance Act. And the following year, what happens? The company is doing a little below 100 million. That makes it a medium-sized company under the Finance Act. But recall, under the Finance Act, anything above 100 million makes an entity a what? A large company. And a large company is taxed at 30%, not 20%. In other words, for an entity that is a medium-sized company that has measured deferred tax, that deferred tax will be measured using 20%, which is the company income tax rate for medium-sized companies. But if the entity has the possibility or likelihood of making a gross earnings of 100 million and more in the following year, that will mean that the rate to be used to multiply the what we call the temporary differences. The rate will become 30% and not 20%. Therefore, all the temporary balances that you have in your financial in the following accounting year will be measured by 30% and not 20%. What happens? Currently, you reported a deferred tax position using 20%. If within the next 12 months, the entity becomes a large company and deferred tax is measured using 30%, what happens? The same temporary difference may exist, but the amount of deferred tax asset or liability will have changed. Why? Because a 30% is used. There's another example of an estimation, a source of estimation uncertainty that needs to be disclosed. That's what we are saying. Under key sources of estimation uncertainty. Next, we must see statements of significant accounting policies and judgment made in the application. You don't just present the primary financial statement, statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flow. These are the primary ones, but you don't stop there. We must also disclose the accounting policies. Accounting policy must be disclosed for every item. I repeat, every item that appears in the component of the primary set of financial statements. The primary financial statements, statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows. These are the primary financial statements. Any item contained in all of these must serve an accounting policy disclosed. If you have a PP and any item of property, plant, and equipment, intangible assets, investment property, biological assets, long-term investments, right? Deferred tax assets, any kind of liability, any kind of current assets, any kind of income, expense, any kind of component of equity, for all of these, so long as you pay your financial, there must be a disclosure of the accounting policy governing how that item is prepared, presented, and measured. Is a must. Is a must. So let's take note. So it's not enough to just present the primary item. You must disclose the accounting policy. Then no, it is possible that an item may exist in a current year, let's say 2023, but that item did not exist in 2022. Of course, there must be a policy communicating on the reporting of that item that exists only in 2023. It is also possible that an item might have existed in 2022, a comparative year, but no longer present in 2023. Because we do comparative reporting, an entity is also bound to still present the accounting policy of that item, even though the item no longer exists in 2023, but existed in 2022. So for any item presented, either for the current year or for the comparative year, an accounting policy must be presented. In accounting policy, let's take note. The judgment made in developing accounting policy must be contained in that accounting policy. The evaluation, the consideration made must be contained in accounting policy. We don't just say that the motor vehicle are measured on a straight line basis. Is that all? Not at all, not at all. So you need to go through IFRS 16, right? The accounting policy will tell us what are the items called PPE? What is the meaning? The definition is in IFRS 16. How are the costs aggregated? How is it measured at initial measurement? How is it measured in subsequent measurements? Recall for PPE, for subsequent measurements, they are measured at either using the cost model or the evaluation model, remember, under IFRS 16. You tell us, what is the depreciation method? And what informs the depreciation method that is used? How is impairment measured? Impairment. You see, you are connecting IFRS 16 to IFRS 36. How is impairment measured? How is recoverable amount determined? We say the higher of what? Who can tell me the formula for recoverable amount? Who can tell me the formula of recoverable amount? Anyone, you may chat in, you may unmute and speak. The formula for recoverable amount, please. Who can? For those on this call, can you chat in? Chat in or unmute and speak. The formula of recoverable amount. It is contained in IFRS 16. Okay, in IFRS 16, the formula for recoverable amount is the higher, two things are compared. Fair value less cost to sell on one hand, fair value less cost to sell. Let's say you want to realize an item of PPE, right? What is the fair value, one, and what are the incidental costs to incur in trying to realize that fair value? So fair value less cost to sell is on one hand. We also compare with the value in use. What is value in use? Let me practicalize. By having a motor vehicle, by having a building, by having a factory, that motor vehicle, building or factory enables you to carry out some activities. If you were to rent that factory, if you were to let it out, if you were to take an Uber instead of owning a vehicle, if you are to hire the machinery or go on an operating lease for that machinery, how much will you have paid? In other words, by owning that item, what is the inflow that comes to you? Inflow that that item can generate or attract. If you are to go to hire it or to lease it, or if it is to be, given to you in reverse by the owner, what cash flow can come in. Cash flow does not mean you have to sell it. It's about the service capacity, the monetization of the service potential of an item of PPE. That monetization in cash flow over its lifespan, when you determine the present value of that future cash flow, right, associated with that item. If you have to hire a vehicle every year for 3 years, the meaning is your hiring cost for that 3 years, when you discount it to the present value, that will give you the value in use. Value in use. It is the monetization or assigning monetary value to the service potential or service offering or service benefit of an item of property, plant, and equipment. That present valuation of those future cash flow is what we call the value in use. So we compare the value in use on one hand and fair value less cost to sell on the other hand. The higher of them is called recoverable amount. The higher of them is called recoverable amount. So if the fair value less cost to sell is higher than the value in use, we go with the fair value less cost to sell. If the value in use is higher than the cost to sell, is higher than the fair value less cost to sell, we go with the value in use. So that value in use, or fair value less cost to sell, is going to compare the carrying amount. Where they are less than the carrying amount, we say there's an impairment. But we are not dealing with IFRS 36 here. We're only trying to say the information that must be contained in accounting policy for property, plant, and equipment. Tell us, how do you carry out impairment for that item? When you dispose of that item, how do you treat the disposal gain or loss, as the case may be? All of these are contained in accounting policy, and you must tell us your judgment, the evaluation made, or the consideration that are made in arriving or in coming with that accounting policy. That is displayed that must be seen. Number 12, risk management framework. Risk management framework. There's a standard called IFRS 7. IFRS 7. The title of that standard is Financial Instruments Disclosures. That standard requires, yes, please, go ahead.
It's Hope.
Okay, Hope, go ahead.
IS 16, we've been taught that lease is not part of the property, is not recognized as assets because it does not meet all the requirements of an asset.
No, what I mentioned, okay, lease. Okay, let me clarify. I mentioned IAS 16 in describing PPE. I didn't mention IFRS 16. I mentioned IAS 16, which is property, plant, and equipment, right? Now, but let me clarify what you asked. Under leases, even though you are not the owner in an operating lease, do you know what IFRS 16 introduced in leases that was not there in IAS 17, the former standard? IFRS introduced what we call the concept of right of use assets, ROU assets, right of use asset. In other words, even in an operating lease, where you are the lessee, you do not intend to own it. Do you know what the standard says? The standard says, yes, we know you are a lessee, we know it's an operating lease where you do not intend to own it. Do an evaluation of the economic benefits of that underlying asset. In other words, if you've rented a property or you've gone into a long-term lease, or a building for 30 years, and you have to pay a certain amount every year for 30 years. Remember, you're a lessee because you're a tenant, you're a lessee, and that's an operating lease. What does IFRS 16 say? It says, those amounts you have to pay for 30 years in the future. Determine the present value. Determine the present value. The present value of that amount you have to pay as a tenant to that building for 30 years, that present value is called right of use asset on one hand, and concurrently it is called lease liability. That is why in any financial statement of an entity that has a lease that is going, whether it's an operating lease or not, you must see a right of use asset as an asset, where that right of use concerns the future amount amount that will going to arise for beyond 12 months or 12 months and above, right of use asset is classified under non-current assets. Where the cash flow is around the portion that has to do with the payment you're going to make, the present value of those payments you have to make within 12 months, say next year, that right of use asset is classified under current assets. So, and the amount you measure or you arrived at as right of use asset ordinarily at start of that list, most time is similar to the lease liability. What am I saying? When you determine the present value in an operating lease as a lessee, you recognize two items. An asset called right of use asset that has a debit entry and a lease liability that has a credit entry. I'm not going to clarify under IFRS 16, even though you're a lessee in an operating lease, the present value of the cash flow associated with an operating lease transaction must be recognized as right of use assets. Whether, so that is the position under IFRS 16. I just want to clarify. But that does not mean that that item is classified as a PPE. The only condition where a lease item has to be stated in its name is if that underlying asset is an investment property. Where your company is a tenant, right? IFRS 16 says in your book, even though you're a tenant, you are to state the name of that right of use asset, not as right of use asset, but as investment property. You put that present valuation of the future cash flow there. Look at it, it's sounding somehow. You state investment property, even though you are not the owner, and you do not intend to be the owner. IFRS 16 requires that only for investment property, you must state the name as investment property as part of your non-current asset in your statement of financial position. But for every other underlying asset, for every other underlying asset in a finance lease, right? For every other underlying asset in a finance lease, there are two ways in a finance lease. You can state it as a right of use assets line item, or you can state it as part of the component of the PPE that is the underlying asset. In other words, if a motor vehicle is the item under a lease contract, under a finance lease, where you are a lessee, how should you state it? You can state it as right of use assets, you write the value, or you can state it as part of the motor vehicle in the face of statement of financial position. But in a finance lease, when the underlying asset is a building, in a finance lease, when the underlying asset is a building, you state it as investment property. You don't combine it with anything whatsoever. You state it as investment property. But for all other operating leases, I'm not talking about finance lease now. For all other operating leases, where you are a lessee, the line item is what? Right of use assets. Not the name of that item. It is right of use asset, not the name, because it is not a finance lease. Of course, you are not intending to own it, but you must state it as right of use assets, either as current or non-current, depending on the portion of the present value that has been, ascertained, in line with the lease term or lifespan of that item. That is about that. So my point is, under IFRS 7, the what we call financial disclosure, the standard is not just talking about figure. We want a disclosure of risk. And for risk, there are two components. The risk that exists on the risk that exists on financial assets and liabilities, and how those risks are managed. Is it enough to say you have a trade receivable 20 billion? Yes, we've agreed, 20 billion receivable, trade receivable, fine. What happens if that debtor is an individual who dies the following morning? Goods you are not in control of. You don't know the wife, or the man is divorced, a divorcee, or is single. You don't know anything. Your trade receivable of 20 billion will amount to nothing, because there was a key man risk, because the debtor was an individual. not a company. Let's even assume that the debtor is a company, but the company has just gone illiquid or is to be wound up. What happened to the 20 billion? Remember, you were taught bankruptcy, law of bankruptcy and executorship in school. Under liquidation, they are called preferred creditors. Preferred creditors, all amounts that are owed to government and government agency. You must pay government. Is a top line item. We also have secured creditors, people you are owing that have collateral they are holding or collateral cross to their name, even though the collateral is in your possession. But there's a fixed charge on that debt. We call them secured creditors. Then we have unsecured creditors. That is where people like your company will come in, trade receivable. You get your company goods on credit, the company went down. There was no collateral. You come under what? Unsecured creditors. Therefore, that 20 billion is gone and gone forever. In IFRS, it's not enough to state your financial assets or financial liability. We want to know the risk inherent in that asset and liability. And number two, we want to know what is the framework for managing those risks. Therefore, under risk, we have credit risk. The risk that your debtor will not pay you. We have what? We have the credit risk, the risk that your debtor will not pay you. And also the risk that your financial asset that you have, investment, will fall in value. That is credit risk. We have liquidity risk. The risk that an entity will not meet its obligation or fulfill its obligation as they fall due. That is called liquidity risk. Number three, we have market risk. The market risk could be interest rate risk. The risk of the foreign exchange rate between a functional currency and a foreign currency will move against the entity. That is interest rate. That is currency risk. Currency risk. The risk that the exchange rate between a functional currency and a foreign currency will be in adverse condition to the reporting entity. That is currency risk. Currency risk is an example of market risk. Another risk is the interest rate risk. Interest rate risk is an example of market risk. It's the risk that there's going to be a change in the fair value or cash flow of a financial instrument as a result of change in the interest rate. When the bank gives you a loan at 23%, the bank has the right to review the interest rate so long as they communicate to you. And then they are taking a loan for 20 million naira at 23%, and 6 months down the line, the interest rate has changed to 30%. What has happened? The entity will be forced to pay more interest expense because there's an increased interest rate. That's an example of interest rate risk. It has a cash flow impact. That's what we are saying. Also, when an entity gives a loan, say you are the one giving out the loan. So when an entity, takes a facility or a line, right? In foreign currency, it has two components. There is a currency risk component, there's an interest risk component. But this is a summary of this disclosure. Disclose the credit risk, disclose the liquidity risk, disclose the interest rate risk, disclose the currency risk, disclose the operational risk, disclose other price risk, and more importantly, what is the risk management framework that an entity uses to mitigate or to proactively manage the likely crystallization of that risk. That is what IFRS 7 is about, financial instruments disclosure. But this risk management framework is with respect only to financial instruments. Only to financial instruments. So this is another disclosure that is required under IFRS. Let's take notes. Now we now go to notes. Yes, notes. The notes are looking at notes. Notes, we always know about notes. There's nothing to say about it. Notes, the one used to call notes to the account. They are notes to the financial statements. You don't just present trade receivable, revenue, cost of sale, and you stop there, there must be a note. A note gives a disaggregation or further qualitative information about a line item. It gives a disaggregation or a breakdown of other information about a line item. So whether the line item is in the statement of financial position, or whether it is in the statement of comprehensive income, or whether it is in statement of cash flows, or statement of changes in equity, that line item should have a note where there is more information to be shared or a breakdown is to be made about an amount. That breakdown is called a disaggregation. So a note is a compulsory component of a set of IFRS financial. Now, if you look at the number 14 and 15 points, they are in red color. What do they mean? An entity may be adopting IFRS for the first time adopter of IFRS. When an entity adopts IFRS for the first time, that entity is required to prepare what we call a reconciliation. You know, you convert from NGAAP to IFRS. By converting from NGAAP to IFRS, some amounts will have changed. Ultimately, the equity, or what you call the net assets, net asset, will have been affected because of some write-off or some recognition or some remeasurement that will have been made or some reclassification. This will have an impact on the equity on the net asset. So under IFRS 1, first-time adoption of IFRSs, it requires that entity does a reconciliation of what the NGAAP line items or amounts were before, the adjustments that were made, and what they have become under IFRS. We call it explanation of the effect of transition from NGAAP to IFRS. So for a first-time adopter, apart from what you have mentioned from number 1 to 13, that entity must also have a disclosure stating how all the line item in what you used to call balance sheet, for example. Of course, it can still be called balance sheet anyway, but popularly, statement of financial position. What you used to call balance sheet, all those line items, what adjustments were made to them for them to become a given amount? For them to become a given amount under IFRS. So you do it for items of your statement of financial position with focus on the net effect on equity, and you also do it for items of your statement of comprehensive income with focus on the profit for the year. This reconciliation only apply to the comparative year. I repeat, these reconciliations only apply to the comparative year. In other words, if we adopt IFRS in 2023, 2023 is the current year. The comparative year for 2023 is 2022. Therefore, reconciliation of the income and expense line item in the statement of comprehensive income in 2022, in the statement of comprehensive income is only applicable to 2022, which is the comparative year, not 2023, which is the current year. So the reconciliation is for the comparative year for statement of comprehensive income. That is on one hand. Then, for the statement of financial position, the reconciliation is for both 2022 year end and the beginning of 2022. Recall that statement of financial position are for 2 days, are on dates. It's not for a period. It is as at a date, as at a point. So you do a reconciliation as at December 31, 2022, 1. And that reconciliation is to show how the line items and equity was affected. You do the same reconciliation as at the beginning of 2022, which is the date of transition, for all the line items concerned and for the net effect on equity. So 2 points. 2 points for statement of financial position as at the date of transition, which is the beginning of the comparative year, and as at the date end of the comparative year. So these reconciliations are required only for entities that are presenting a report that contain the adoption of IFRS for the first time. But for an entity that has already adopted IFRS or that is already in an IFRS era, that entity does not present anything about information 14 and 15. Let's take note. Let's take note. Now, information number 16, lastly, as we sign off. Information number 16. I explained before, when there is a reclassification of an item, or where there is a change in accounting policy, or where there are material prior period error that occur, prior period errors that occur before a comparative year, and then they must present a third statement of financial position. Recall I said it from beginning. I'm now recapping. Where there's a reclassification, 1, where there's a change in accounting policy, 2, or where there's a prior period error that occur before a comparative year. Before a comparative year, and then it presents the third statement of financial position. And the financial position is not presented or prepared, that is on a period or period end before a comparative year. So this is a summary of the collection of the items that you must see in IFRS financial statements. This is a summary that must be seen in IFRS financial statements. Let's do it. Then in Nigeria, not for other countries, in Nigeria, when an entity is in Nigeria or reporting under the Nigerian jurisdiction, you are required to disclose further items. We call them other national disclosures, OND. Other national disclosures, OND. Even though they are not part of IFRS, the Financial Reporting Council of Nigeria stipulates that it must give us information about your statement of value added. What is the core value added statement? You will present statement of value added, of course, for the current year and the comparative year. That's number 1. Number 2, the 5-year or 3-year financial summary. 5-year or 3-year financial summary. I refer to 3 years. For an entity that is 3 years old, 3-year-old, you can only have a 3-year history. For an entity that is 2-year-old, we don't talk about financial summary, because if you're reporting for your 2nd year, compulsorily, you're already reporting comparatively, so that covers 2 years. So you are required to report either a 3-year financial summary or 5-year financial summary in addition to your statement of value added. So you present statement of value added and also your 5-year, your statement of 5-year financial summary if you're a Nigeria entity. Thirdly, it is possible that your functional currency in your industry is the dollar or pound sterling. For example, entities in oil exploration, their functional currency is not the Nigerian naira. No, it is in US dollars. Therefore, ordinarily, their financial statements will be presented in dollars, ordinarily. But in Nigeria, the FRC also requires them to present their financial in naira. In other words, as they're presenting in dollars, there must be a naira column for all the items those categories of entities are reporting. Therefore, for entities whose functional currency is not the Nigerian naira, they are required to present their statement of financial, they are required to present their primary financial statements also in Nigerian naira. So all of these will come under other national disclosure. Other national disclosure. So let's take note. So that is that about that, and we are done for this. So before I ask whether I have any question, let me quickly do a rundown of our case financial. This is the Nestle financial. Look at a composition of all the accounting policy that they have. When I scroll down, look at accounting policy on foreign currency, financial instruments, financial assets. That way you can see the accounting policy. I'm just running through the accounting policies covering all items that exist in the financial statement. That is what you are seeing. You can see more of them. If you want to see them in detail, you can go to the Nestle website to download them, right? You can see all of that. Every single thing on all of the standard. Employee benefit IS 19, provision, revenue, statement of cash flow, revenue, that continued. You see taxes, income taxes. You see all the policies, all the accounting policy, and all of that. Now, from when they're done with all of the policy, you now begin to see things that have to do with those other items we mentioned. Now, look at here. The stated list of standards have been issued that are not yet mandatorily applicable. You can see they listed them, as I said before. All of these things you see in line with what we listed. And then you're going to see, of course, the key sources of the estimation uncertainty, the consideration they made with respect to specific asset and liability. You're going to see all of them. So you now see the notes of the financial statement. This is about operating segment, for example, operating segment, right? So in that order, operating segment, in that order, you see them in that way. This is revenue. So this is just to buttress what we said and nothing more. So as an assignment, let me go back to the page we share. As an assignment, when you go to the YouTube page, you are going to see this information, this collection of items that make up financial statement that you must see when analyzing IFRS financial statement. So we're going to, for those of you on the platform, if you are not on the WhatsApp group, drop your number, drop your WhatsApp number, or let's pick and add it to the group. So long as you are in 400 level, or you are waiting NYC, or you're on NYC, or you have completed NYC recently, these are the 4 categories. No other person is qualified other than these 4 categories. Drop your number, we'll add it to the group. We're going to have this on a weekly basis now. So next week, we're going to choose a topic. We're going to announce it just 2 hours every week for all those who are interested. We'll be dealing with different areas, different topics, and all of that. We'll be dealing with them every single day, every Saturday, 10 to 12. Let's take note. So drop your numbers, we're going to add it to the WhatsApp group. And for the assignment, in that group, we're going to request you to do us an analysis. Download any financial statement of your choice. We're going to log on where you run us through what we've done in this session. So everyone who is interested, who is going to be on, who is on that group, or who is going to drop his number here that we're going to include in that group on WhatsApp, we're going to choose a date and timing for you as you want. Individual, it's not a group team, but anybody can join. Where you run us through what we have done. So that is that for now. So any question on this as we sign off? Because we are done. Any question on this? Do you have any question? Does anyone have any question, please? You can hit the chat button. If you don't have, you just say no. If you do, unmute and speak while we sign off. Okay, so I think we don't have one. So if you are in 400 level, are watching NYC on NYC, or completed NYC recently, and you're not on a WhatsApp group, please drop your phone number. We're going to add you to that group, number one, and then we'll take it up from there, because we want to develop and get you ready for the real life, right? So it's not a lecture per se. So we're going to schedule another session where you take your individual assignment as we respond to them. So thank you for your time. Thank you, Obioma. That is Obioma Ba, I do not know. But thank you. Thank you for allowing your advocate. Thank you, Hope, Ken, Namani, Promise, and others who have logged out before now. Thank you and bye for now.